you ever wondered whether your money is safer with a bank or an insurance company? My dad and I were talking about this recently, and he made a really interesting point. He said banks can go bankrupt, but insurance companies, not so much. And here's why that might be true, especially in Singapore. Banks and insurers are both heavily regulated in Singapore, but they operate differently. Banks take deposits and then they lend that money out, often into loans or investments that come with risks. If things go wrong, like in a financial crisis, banks can suffer big losses, and yes, a bank can collapse. That's why we have deposit insurance. In Singapore, it's up to $75,000 per person per bank. Now, insurance companies don't work that way. They collect premiums and set aside what's called reserves, money that's legally required to be held to pay out future claims. They're actually not allowed to take too much risk with that money. In fact, in Singapore, insurers are governed by MAS and have to follow strict capital and solvency rules. That's because their promise to be there in 10, 20, or even 50 years has to be rock solid. So, are insurance companies safer? When it comes to long-term financial protection, their stability is kind of the whole point.